Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are going over the theory for Chapter 11, which is on the statement of cash flows. And in the last video, we had covered, get my pen here, we had talked a little bit about cash being king and why we're creating a statement of cash flows versus financial accounting, and tried to give just a little bit of an insight into what we're doing when we create that statement. We're taking our balance sheet information and our income statement information, and we're adjusting it so that we can end up with what is our cash position. Now in this series of video, well, in this video, I'm going to be talking about this section on the statement of cash flows themselves, and there's three sections: the operating section, investing section, and the financing activity section. Right before, and in each section, what we'll be doing is we'll be going over the common adjustments. And like I said in the last video, that's like 95% of the adjustments. And if you that you'll make in order to create the statement of cash flows. And if you understand the thought process behind making the adjustments, whenever you see something that you've never seen before, right, you can go through the thought process as to how to arrive at cash and use it for the new situation. So again, it's about understanding and application. But for the most part, since there's so much, generally there's a lot involved in order to create the statement of cash flows, it does help to go down in almost a step-by-step list, a checklist. Did I look at this? Did I look at that? Did I look at this? Did I look at that? And did I need to make those adjustments for it in order to arrive at what your statement of cash flows should look like? Now, before I go there, and start talking about those transactions, it helps, it helps to keep things in the back of your mind as to what it is that you're doing. Okay, I mean, we're talking about here as an idea. Okay, we're talking about the statement of cash flows, right? So why are we creating a statement of cash flows? Well, the idea in the back of your head is that we want to get to a cash position. All right. So if you keep that in the back of your mind, and you know the difference between accrual and cash, whenever you see something that is an accrual, like a depreciation expense, adjustment at the end of the accounting period, you know that doesn't affect cash at all. All right. All it is just reducing the book value of your asset. All right. And therefore, it doesn't belong on the income statement. And if it doesn't belong on the income statement, it's affecting that net income. So it doesn't, you need to take it out. You have to adjust for it. Okay. So in creating the statement of cash flows, we're always thinking about, in the back of our head, how do we get to cash? Now, with the operating activities, investing activities, and financing activities, these are the three sections that businesses are generally made up of. Operating activities. Operating activities, keep this in the back of your head, right? Operating activities are what? It's, you're producing the product and selling it, all right? It's you're performing the service and getting paid for it, all right? Um, if you'll recall in one of the previous videos, I had said I think about business in three different areas, okay? One is the sales and marketing, okay? The other one is in business management, right? And the business management is the operation aspect of it. And then there's the accounting and finance, right? And I had said, as far as a business is concerned, if you think about it in these three areas, sales and marketing, they're out there doing what they need to do in order to get people to buy the product or service. Then it's up to the business management people in order to, that's the operation of the business. That's the a sale was made by our sales and marketing department. That's our revenue, and then our expenses are from the business management aspect in producing that product or performing that particular service. And that gives us a profit or loss, right? That's our net income or our net loss, right? And then, of course, accounting and finance, well, that's the accounting people. They're the ones who have to, they need to know the totality of business. That's why it's the most difficult curriculum out of all of the business groups, because they have to have some idea as to what sales and marketing is doing and the business management. But they're the ones that are keeping track of all of the transactions, putting together the financial information, analyzing it, and giving business advice. All right. So those are the three sections. But when we sit down and we look at it, we want to, what are we actually doing? Well, we want to create a net income, and that's created by the operation of the business. So anything that has to do with, you're making the sales as far as revenue less expenses is concerned, we're going to be looking at the operating activities. That's in that particular section of the statement of cash flows. Okay. In that last video, I showed we're taking out depreciation. We were looking at our income statement, and we had our revenues less our expenses, right, which gave us our profit or loss, our net income. So what we're doing in the operating activity section is we're looking at that net income and we're adjusting it so that we're reducing things down to just basically our cash position. Okay, so remember, keep in the back of your head, why are we doing things? We want to look at the cash position. So operating activities is making and selling the product. All right, the operation of the business, why you're there. Investing activities are when the business actually invests in something as an investment activity. You think about that from the perspective of, basically investments. Let's say, you get big companies like Microsoft or Google, when they get extra cash, they will take that extra cash and invest in other things. I had, throughout the, someplace along the line in these previous chapters, I have talked about marketable securities, okay? Where, a company like Microsoft, when they have extra cash, they'll go out and they'll buy the stock of other businesses. Okay, that is an investing activity. Or they might buy another business as an investing activities. Now, the vast majority, not the vast majority, a majority of your adjustments are going to be made in the operating activity section, right? You're not going to have that many activities in your investing section because most businesses, uh, even mid-sized businesses don't do much as far as, investing is concerned. Okay. But in financing activities, that's the section where, you're getting bank loans, this type of thing. Okay. Maybe you're getting a loan for construction on an addition to the business or something like that. So you have these here in activities where you have to finance, and those adjustments are made in the financing activities section. So if you ask me as a general overall basis, the majority of your transactions are going to happen in the operating activity section. Right? The second most common would be the financing activities, because a lot of businesses will finance something before they actually make investments in other things. Okay, so then investing activities would come in third as far as um, adjustments that you'd have to make. So with that said, let's move on. Now remember, you haven't even seen, or at least I haven't shown you what a statement of cash flows looks like yet. Okay, and that's fine. I'm trying to build a framework for you to be able to think, and when you look at a statement of cash flows, it'll be like almost having X-ray vision in that you understand how it's all put together. Okay, very similar to your income statement, right? On the this is a repeating of theory, but reality is that you can have one account called a revenue account, and you can have one account called an expense account, right? And when you subtract one from the other, you end up with your profit or loss. But that doesn't help you, all right? I mean, it meets the basic requirements, but it doesn't allow you for you to do any analysis. So what ends up happening is you create additional revenue accounts and you create additional expense accounts, okay, which helps you with the analysis of your business. All right. Well, this is sort of the same exact thing. We're looking at the overall structure of our statement of cash flows, right? Um, without, and I haven't presented one yet, but I'm trying to get you to see and understand the reasoning behind it. We're adjusting to cash, okay? And in order to adjust to cash, we're going to create that statement of cash flows in 3 sections. And then each particular section is going to look at something different that pertains to the business: operations, investing, and finance. And when we look at each and every one of those, we're going to see where we're going to have to make adjustments so that we can get back to our cash position. Right? So let's move on. Down. Why am I going up? All right, there we go. Oh, wow. Okay, so, wow, I wonder why that did. Okay, my computer's been kind of going screwy here lately. So, yeah, I wrote all on this, I was writing up here, okay, and basically I should have been using this slide. Neither here or there. All right, so in our operating activities, these are what you're going to look at the most. This is your checklist, okay? And remember, as we go through the next 3 slides, that's going to make up 95% of what you're going to look at on your financial statements. And the remaining 5% is not something that you're going to see on these slides. But if you think through these processes and you understand how, what you're doing here, then you can apply that to that 5% of situations that you've never seen before. Okay, so when it comes to operating activities, pause the video and write these down if you want, but they are in your textbook. That's where I got them from. All right. These are the things that you're going to consider. The first one is the accrual basis for your net income or loss, and you'll get that from your income statement. Okay, so what that means is you're going to start out with your net income, and we're going to adjust that. Then what we're going to do is we're going to take our non-cash expenses and losses, okay, and we're going to add them back in, and we get that from the income statement. And you'll see examples of this as we go through a little bit later, and of course when you're doing the homework problem. So right now I just want you to get the overall concept. Notice it says non-cash expenses and losses, okay? We're going to add them back in. That's what the plus is, okay? So when we have a non-cash expense, all right, think about it from this perspective. We have our revenues, and this is just an idea, and then we have our expenses. Okay, and let's say these revenues were $100 and the expenses were $30, okay? And that gives us a profit or loss of $70. Well, if one of those expenses was a non-cash expense like depreciation, okay, and let's say depreciation was $10, out of this $30, 10 of it was for depreciation, okay? Well, notice it says we're going to add that back in. So we're going to add that $10 back in, which would give us $80 of profit or loss, because why? If I took it out, right, if I subtract it out, because it's a non-cash expense, well then I would only have $20, and the difference between those two would give me my 80 anyway. Okay, but we're not doing that. What we're doing is we're saying we're starting out at $70 here, all right, as our net income, okay, and then what changes are we making to the $70? We're going to add in our non-cash expense. Well, our non-cash expense was $10. Remember, we took that away because depreciation, it's an expense. We're taking that away from our profit or loss, right? Well, now we're going to add it back in, right? Which would then adjust our net income to $80 on a cash basis, right? So I hope you see and understand that it gets a little confusing, and this is where, you know, you have to have these fundamentals down where you know what the normal balances of things are, you know. I mean, if, you know, by now, a lot of this stuff should be second nature, but if you didn't, then you got to go back. If you're not getting it, then you have to go back and revisit that information earlier in the textbook, right? Right, so we're going to add in non-cash expenses, and then we're going to minus non-cash revenues and gains, and this comes from this income statement. So where this here is the adding in of the non-cash expense, the opposite is we're going to minus the non-cash revenues. Okay, revenues on the income statement, we're adding revenues, and then we're subtracting expenses. But when we're adjusting for the cash position, okay, when we're adjusting for the cash position, we have to do the opposite. Since we added revenues, now we're going to subtract revenues. When we subtracted expenses before, now when we adjust for the cash position, we're going to add them back in, and that's why it's a plus and it's a minus. Plus for revenue and a minus for, a plus for expenses and a minus for revenues. Okay. Now, next one here is we're going to plus our decreases in non-cash current assets, and we get that from the balance sheet. Things like this are going to be your accounts receivable, okay? Current assets, right? Accounts receivable is non-cash. So when our accounts receivable decreases, all right, we're going to add those back in, all right? And then we have to do the opposite. We're going to subtract out minus the increases, all right? Notice how these two are related together, the expenses and the revenues, all right? Well, now notice that increases and decreases to our current assets from the balance sheet. So think about, get in your mind that when we're talking about non-cash current assets, we're thinking about something like accounts receivable, and we're adjusting for the increase or the decrease in the accounts receivable, right? And if the accounts receivable decreases, we're going to add it back in. If the accounts receivable increases, we're going to subtract it back out. Notice that both of these don't happen at the same exact time for the accounts receivable. I mean, if my accounts receivable was 100,000 and now it's only 80,000, well, that's a decrease, right? That's a decrease because we went down, right? Well, if we come over to here, it says, our accounts receivable decreased. So what we're going to do is we're going to want to add that $20,000 back in, all right? And that's kind of like how that works. And you'll see it in the exercises, right? And then we have to consider, our liabilities, our current liabilities, okay? And again, that comes from the balance sheet. And it's the same thing as our current assets. We have our increases and decreases, whether we're pluses, adding or subtracting of it. So when it comes to the operating activities here, if you think about them, don't just look at this as a list and try to just go down this list. Because what's going to happen is you're going to do this one, you're going to say, okay, I have my net income, $48,000. And then you're going to come over here and you're going to say, oh, I have expenses, all right? So I'm going to add these back in, that $10,000 for depreciation. And then you're going to say, okay, I'm going to subtract out non-cash revenues. Maybe that's credit cards, so I'm going to subtract out $5,000 for credit cards, okay? But then when you come down here and you're doing these non-cash current assets, you might only be looking at the one account, accounts receivable, and you're going to be trying to do both of these at the same time, which obviously doesn't make sense, okay? So, figuring this out, the increase or the decrease is a sub-step. It's an additional step that you'll have to do in order to decide which one of these two apply before you can actually use it, All right. So if I'm looking at my accounts receivable over here and I was at 100,000 and it went down to 80, right? That's a difference of 20, a decrease. So I would have to add in 20 more here, right? And then we end up doing the same thing for our current liabilities. If I have accounts payable and my accounts payable was say 30,000 and now my accounts payable is 35,000, okay? That's a $5,000 increase. Well, if I have a $5,000 increase, I'm going to add that back in, so plus 5,000. And then the total of this, well, let's just do it here, 58, right? They offset 68, so we're at $68,000 is our, our cash position from the operating activities. So our net income wasn't 48,000 when we're thinking about it in terms of cash. Our net income was actually 68,000 in terms of cash, right? So this is the operating activity section, and hopefully you understood that. We're at 21 minutes in the video, so I'm actually going to pause, and I think what I'm going to do is create 2 more videos, one to cover the investing activities and then one to cover the financing activities, all right, in addition to this one. I thought I'd do all 3 of them, but I started babbling and started talking, and it ended up being longer than I expected. So, right, I'm going to end the video here. If you didn't understand this, watch it again, read the textbook, but everything will start to fall more into place when you actually do the homework problems. And if you still have any additional questions, feel free to contact an instructor. So I'll see you in the next section for investing activities.